This video will provide a walkthrough to the solution for exercise 15-9, which focuses on accounting for defined benefit pension plans under IFRS. Here's the background information for our problem. Frank Limited initiated a defined benefit pension plan for its employees in the year 2017. On January 1st, 2025, the plan shows a DBO or defined benefit obligation balance of $6.3 million and plan assets or PA of $5,950,000. In 2026, the company reported a current service cost of $575,000 and the current interest rate on high-quality corporate bonds is 7%. During the year, the pension plan assets earned a return of $437,000. In 2026, the company contributed $682,000 to the plan, and the plan paid out pension benefits of $186,000. And the company reports under IFRS. There are 3 requirements for this problem, so we'll start with requirement A, which asks us to complete the pension worksheet for 2026. When we construct a pension worksheet, we have a series of columns. We'll have 2 columns dedicated to the pension plan itself, which is actually administered by an external third-party trustee. Here's where we track the numbers for the defined benefit obligation, or DBO, and the plan assets, or PA. Then we have 4 columns to track the pension in the company's actual accounting records, separate from the pension plan. Here we have a net defined benefit balance, or NDB, a cash account, the determination of the pension expense, and other comprehensive income. This last column for OCI is applicable only under IFRS. So we want to begin filling in our table with the beginning balances provided. We know that the opening balance for the DBO is $6,300,000. That's a liability, so it's a credit balance. And we're told that the plan assets have a beginning balance of $5,950,000. Since those are assets, that's a debit balance. Those 2 items are on the trustee's record, but the company records the difference between the 2 as a net defined benefit balance. In this case, the $6.3 million DBO liability exceeds the $5.95 million plan asset balance, resulting in a net defined balance of $350,000 credit, which is a liability on the company's records. So once we've got our balances in, the first item we want to start with is the service cost, or the current service cost. In some examples, you might see this referred to as CSC. You'll never have to calculate this in a problem. This is always given. The current service costs are $575,000. So what this does is it increases the obligation on the trustee's pension plan accounts by that amount. So we will add $575,000 credit to the DBO balance on the pension plan. And to balance the row in our table, we're going to debit the company's pension expense for $575,000. Essentially, the current service costs make up part of the total annual pension expense on the company's records. Next, we need to factor in the interest on the defined benefit obligation. The data doesn't tell us what the interest expense on the obligation is, but we do have enough information to figure it out. The data tells us that the current interest rate on high-quality corporate bonds is 7%. Therefore, we will use that 7% rate on the opening balance of the defined benefit obligation. So if we take $6.3 million and multiply that by the 7% interest rate, that ends up being $441,000. This increases the defined benefit obligation, so we're going to add it to the DBO, and because it's a liability, that's going to be a credit. And to make our row balance, we also need a debit, and that's going to go straight to the pension expense. The next item we have to calculate is the interest on the plan assets. In this case, we're going to use the same 7% interest rate provided. In other problems, you could have a different interest rate to apply to the defined benefit obligation and the plan assets, but in this case, we only have one interest rate provided, so we're going to use that for both calculations. We'll apply that 7% interest on the beginning balance of the plan assets of $5,950,000 multiplied by 7%. The result is $416,500, which is going to increase the value of the plan assets, so that's a debit. To make our row balance, we're going to credit that amount to the pension expense. And the reason why we do that is because the interest on the obligation increases the expense to the company, but that's offset by any interest earned on the plan assets. So what we're doing essentially is recording the net interest expense, the difference between any interest on the obligation less any interest generated by the plan. The other thing to note here is that both the interest on the DBO and the interest on the assets are estimates. because we don't know what the actual amounts earned on the plan are until the end of the year, and sometimes not till well into the next year. So that's why we applied the 7% as an estimate. The next item is the contributions to the plan. The company paid in cash $682,000, so that's a credit to the company's bank account, and those funds are transferred to the trustee, which goes straight into the plan assets. So that's an increase or debit adjustment to the plan asset account on the trustee's books. Next is the benefits paid. This is strictly isolated to the trustee itself. The pension plan paid $186,000 to existing retired employees. So that's going to decrease both the defined benefit obligation and the plan assets. The money comes out of the plan and therefore is a credit to the plan assets. And because it reduces a liability, it's a debit to the DBO. The last item to account for here is what we call remeasurement gains and losses. And this is calculated as the difference between the estimated interest of $416,000 on the plan assets and the actual return on the planned assets of $437,000. So the plan actually returned more than was expected. That difference of $20,500 then is added to the plan assets, and in the company's books under IFRS, this is classified as a remeasurement gain on plan assets and is considered to be part of other comprehensive income. This is because under IFRS, we don't want remeasurement gains and losses to filter through net income on the income statement. Now we have enough to determine what our journal entry is going to look like. And the easiest way to do this is to sum up any of the items in the cash, pension expense, and OCI columns. So in the cash account column, there's only $682,000 in credits. The pension expense nets out to $599,500. That's the $575,000 service cost, plus the $441,000 interest on the DBO, less the estimated $416,500 interest earned on the plan assets. And then we have the $20,500 credit in OCI. For debits to equal credits, we're going to balance that account out with an amount of $103,000, and that's going to be debited to the net defined benefit account. Now we can determine the closing balances. When we add up all the items in the DBO, the opening balance plus the service cost plus the interest on the obligation minus benefits paid, that's $7,130,000 credit balance. For the plan assets, we start with the opening balance, add the estimated interest earned on the plan, add contributions made by the company into the plan, subtract benefits paid out, and add or subtract, in this case add, any remeasurement gains or losses. That results in an ending or closing balance for the plan assets of $6,833,000. If we look at the NDB balance, we had a beginning balance of $350,000 credit, and then we had the $103,000 adjustment based on the journal entry. That results in an ending balance of $247,000 credit on the company's income statement. That $247,000 should equal the difference between the trustees' balances of the DBO and the plan assets. And they do. The $7,130,000 DBO obligation less the $6,883,000 plan asset balance is a net obligation of $247,000. So we know our cable works. The second requirement B asks us to prepare the journal entry required to report the pension transactions in 2026. In essence, we've already done this, but we can put it together in a nice tidy entry here. We're going to debit the pension expense for $599,500. We're going to credit OCI for $20,500. We're going to credit cash for $682,000. And the amount to make the journal entry balance is $103,000, which is a debit to the net defined benefit liability account. And finally, for requirement C, we're asked to determine the net defined benefit balance reported on the balance sheet on December 31st, 2026, and how it would be classified. This one's easy. The only column we're interested here is the net defined benefit balance from the company's accounting records, and the balance at the end is $247,000 credit, so it's a liability, and this would be classified as a non-current liability, simply because the pension plan will be in effect for many years in the future. And that's it. We're done with this problem.